Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Tuesday. John Penn joining me this morning as well. We've got some stuff to get into. Like this morning, we're going to talk about a tale of greed and exuberance in the markets and what the consequences of that were. It's absolutely fascinating. This occurred back, this is actually a lawsuit that is actually being filed, but against RBC up in Canada. And it's a really great tale of what not to do when investing. And so we're going to get into that this morning. It's also, if you want a sneak peek, it's an article on our website this morning talking about greed and how to lose 100% of your money. That's on the website now, realinvestmentadvice.com. Also on Substack at Lance Roberts, so you can get it there as well. If you're not following me on Substack, we're posting a lot of stuff there as well. We've got a whole bunch of new stuff we're going to be posting on Substack also. So be sure and follow me over on Substack now at Lance Roberts. So, all right, couple of things to talk about. This week we have retail sales. This is going to be kind of the big report. Bank of America right now is expecting a fairly strong retail sales number based on credit card spending patterns so far. Now, there's a couple of caveats to this number. First of all, the question is that a lot of companies knew that the port strike was going to happen. What they didn't know was how long it was going to last. They didn't know it was going to last 3 days. So there was a lot of inventory stocking that went on heading up to the port strike just in case that strike went on longer than expected. So that's going to contribute some into the sales data. The other side is also that we're now moving into the retail shopping extravaganza months of the year. Halloween, by the way, is the number 2 shopping day of the year for Halloween. So shopping point of the year because everybody's out buying candy and costumes and all this other stuff. Christmas, obviously, number 1 for spending, so that's still coming. But then we also roll right into this from Halloween. We move right into Thanksgiving, which is right around the corner, which can't wait for that. We're going to be hosting Thanksgiving at our new house, which means that I get to control the food. And we don't do turkey in my house. We do brisket and ribs and chicken. Turkey. It's just, I've never figured out how to do a good turkey. I know there's people out there, don't send me recipes. Everybody, I say this every year and I get like 1,000 recipes from people. Oh, well, it's, all you do is this. My turkey never turns out good. It's always dry. I just don't know. Turkey's just dry. So,
best way to do a turkey?
Brisket.
Have somebody else smoke it for you.
That's true. Yeah. Smoked turkeys actually are good.
Yes.
Smoked turkeys, fried turkey. I am not frying a turkey in a new house. No, that is not going to happen. I'm not setting my whole house on fire for a turkey. Best way for me to do turkey, brisket. So we have brisket, turkey, and dressing in our house. So there you go. Anyway, the point is Thanksgiving right around the corner. Then, of course, Christmas. So lots of retail shopping going on over the next 3 months. This is going to be key data because, again, as everybody is looking at the strength of the economy, particularly when we take a look at markets, this is really where this all comes from, right? 40% of the personal consumption expenditures comes from retail sales. PCE, 70% of GDP. So where retail sales go is very important. So we'll be watching that number really closely on Friday to see just how resilient and how strong the consumer actually is right now. But there is some seasonality to that data also. So we'll have to really kind of parse through that. And of course, we have to compare that on a real inflation adjusted basis also. Are people actually spending more money? Or are they spending more money just to buy the same amount of stuff? That's going to be the big question. Okay. Other big news out today, of course, is that we are now officially into earnings season. Lots of companies starting to report today. We're going to get United Health out this morning. We're going to get a lot of companies this week and next week. Earnings revisions right now are the most negative going back to 2022. So we are seeing a lot of negative earnings revisions for companies. In fact, we're seeing very few upward revisions for companies as a whole, but the negative revisions are very, very large across the board. So the expectations for markets are extremely good, right? We're expecting an average beat rate around 70% for companies to beat earnings. But again, they're beating numbers that we've lowered. So take that as you will. But hopefully right now, the markets are betting on a good earnings season, obviously breaking out to new highs. Markets doing great. We'll talk about that in a sec. But keep a watch on earnings revisions because that's going to be real key, particularly with what companies say about forward earnings coming out of their reports over the next couple of weeks. Here's what you need to know before the bell this morning. So yesterday we talked a little bit about the seasonal buy signal that's in. I got a few comments on our before the bell video yesterday. Got a couple of email questions as well. I know it's confusing, right? We have a seasonal buy signal, and then I go, okay, seasonal buy signal, markets are likely to go higher, but then I talk about managing risk because markets are overbought, extended, deviated, etc. I know those two can exist at the same time. We can have a buy signal, we can have a bull market that's trending higher and still have risk. And when you see things like this, where the market's just basically accelerating higher, we're getting very deviated from the 50-day moving average, that implies that you're probably going to get some type of short-term corrective action. So even though you're in a bull market trend, and even though you have a seasonal buy signal, it doesn't mean that you should avoid risk management because previous deviations from the 50 and the 200-day moving average tend to correct back to that average. That's why that's called an average, because prices trade both above and below that number. And once again, we are fairly deviated above that 50-day moving average. That suggests that you're likely going to get some type of pause here with the markets. Now, that doesn't mean that prices have to correct. It just means that likely prices aren't going to rise. In other words, we could go through a period of consolidation that would allow the moving averages to catch up to the market, or you're going to get a correction in price back down towards that moving average because that's the average, and that's going to help relieve some of this overbought pressure. And by the way, if we take a look at relative strength, we are back to levels that have historically preceded some of these corrections. So yes, you can be in a bull market, and yes, you can have a buy signal that suggests that market prices will move higher over the course of the next few months. That is bullish. In the near term, you also have to be aware that markets are very exuberant and very extended for means right now, and that typically leads to a short-term corrective action that will give you a better opportunity to add money to your portfolio. In other words, buying dips, rather than buying these very sharp rallies. So while there's a lot of exuberance at the moment of people and the markets, etc., this is also the point to where, yes, take a little bit of money off the table. Don't be greedy. And again, this is going to be the whole course of our conversation this morning. There are times to take some profits, rebalance your risk back to your portfolio so that you can maintain the gains that you've built up in your portfolio, and then look for opportunities where markets correct in order to provide a little bit better entry point to put new capital or capital that you've taken profits from, take that capital and put it to work. Again, one of the mistakes that investors make is they buy, as soon as they sell something, they buy something else, and that typically doesn't work out well over time. Take one action, separate the two. One action, I'm going to sell and take some profits. I'm going to reduce risk in my portfolio because portfolio markets are very extended right now. And then when I get a better correction or I get a better opportunity, then I'll put some capital back to work. The buy and the sell are two separate transactions. Those do not belong in the same transaction unless there's a specifically good reason for doing that. So anyway, that's what you need to know before the bell this morning. All right, when we come back, we're going to talk about the gruesome tale of how to lose 100% of your money. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. John Penn joining me this morning. Good morning, John. How are you?
Good morning. How are y'all?
So I asked John if he had heard of this story that I wanted to discuss with you this morning. He says, yes. He says, I heard of it as soon as I read your blog this morning.
That's right. Hot off the press.
So there's an iconic movie with Michael Douglas, Charlie Sheen, Gwyneth Paltrow. Yes. Who was the girl?
I think she is.
Is it Gwyneth Paltrow? Called Wall Street.
So.
It's 1987 Wall Street. And in this movie, it's a movie about Gordon Gekko, who is this Wall Street power broker in New York, and he is, he takes over companies and he breaks them up and sells them off and into pieces, and he's got a very bad reputation for being basically a Wall Street tyrant, right? Daryl Hannah, thank you, not Gwyneth Paltrow. Yeah. Daryl Hannah is the one with the candles. There's a joke behind that one. Yes. Anyway. So anyway, in this movie, he is going to go take over this company, and, he goes to give this presentation, and in this presentation about why what he does is good, he explains the value of greed. He says, the point is, ladies and gentlemen, that greed, for lack of a better word, is good. Greed is right, greed works, greed clarifies, cuts through and captures the essence of the evolutionary spirit. Greed is in all forms of greed, for life, for money, for love, knowledge, has marked the upward surge of mankind. Greed has a very dark side to it as well. Particularly when it comes to investing. And importantly, though, you have to understand that greed is necessary to build wealth. We've talked about this before, is that, you can be very pessimistic and sit in cash, and it's hard to build wealth that way. In order to build, you'll never meet somebody who's made a lot of money that A, isn't greedy, B, isn't a risk taker, and C, isn't optimistic. right? It requires those three functions in order to make money. You have to be optimistic about the future, because without being optimistic about the future, you won't take risk. If you don't take risk, you can't be greedy and make money, right? So those are very important factors into building wealth over time, no matter whether you're running a business, investing in the markets, no matter what it is. So there is a young gentleman, his name is Christopher DeVocht, and I may not be pronouncing his last name correctly. He's Canadian, but you get the idea. Back in 2020, when we shut down the economy, we were sending checks to households and all these type of things, and markets were going crazy. Remember, this was the whole Wall Street Reddit, thing that was going on. Everybody was, taking on, GameStop and all this stuff. We just had this massive boom and young investors coming into the markets, completely inexperienced, trading options and trading stocks on, Robinhood apps and those type of things. And Christopher was one of these young gentlemen. He was a carpenter, construction worker, made a modest living, didn't have really much. He had about $88,000 saved up. And he started trading options on Tesla. And Brent, can you bring this chart up for me here real quick? So this is a price chart of Tesla, and this is going to be important to our conversation this morning. And you'll notice back in 2020, and this is a chart of performance in the stock price of Tesla. Tesla went up 1,700% in 2020, 2021. So you had a 1,700% increase in Tesla in 2020, 2021. And in this period, Christopher was trading options, and he was trying to figure out ways. He was advised by, he went and got a broker at RBC. They advised him on a couple of things, hired an accounting firm to help set up an LLC in order to try to shield taxes. And, he was, trading heavily in these options contracts, and he turned his $88,000 into $415 million. Now, the problem is that, if you can bring that chart back up one for me real quick one more time. The problem is the right-hand side of this chart, where the value of Tesla declined rather sharply in 2022. That 1,700% return dropped down to just about 500%. Now, the problem for Chris was he still made 500% on his money, so 88,000 times 500%, not bad, right? Well, this is where you can take it down. This is where the problem of options trading and margin come into play. When you're trading, their options are binary, and some of you in the chat that are following along right now, y'all trade in options because I see your comments. So you understand that options either make money or they lose 100% of their money. There's no in between unless you sell them early, right? If you hold an option till maturity, it's binary. It's either a win or a loss, and it's a complete loss. It's not a partial loss, right? You don't get some of your money back if you hold it till maturity. So he's heavily trading options on Tesla, and is advised to basically take some of the shares of the stock into holding to help avoid taxes or minimize his taxes, that he then margined in order to keep trading more options. And there's a lot to this story, and there's articles out there if you want to read all the gruesome details of it. He claims that RBC never advised him to do any risk management. Maybe that's the case, right? Because RBC obviously was making money off this guy trading options. So I highly doubt it, though. Just from a risk management standpoint, and you have to understand that as an advisor, so as John's an advisor, we're all in this business, we're heavily regulated, and we are a fiduciary firm. So we have to protect ourselves, because the way this works in reality is that client is invested in stocks, and they're doing all kinds of crazy stuff, and the advisor is liable for some of those actions because of the way the legal system works. Is, if these things go to arbitration, they don't go to court. It's a panel. The panel generally sides with the client. It's not a good outcome for advisors in a lot of cases, in these types of cases. So advisors are very conscious of this, and there are plenty of instances where we have clients that come in, they have heavily concentrated positions, and we work with them to reduce those concentrated positions. We try to work with them to hedge, etc. But in some cases, the client's like, no, I want to do this. And they're willing to take on a lot of risks that we advise them against taking. But again, it's their money. They can do what they want, right? But at this point, they've been advised not to take on those type of risks, which is why you want to make sure and always do this stuff in writing and keep good notes.
Absolutely, because I will tell you, there's a fine line. The relationship that an advisor, even a fiduciary, has with their client, it's not necessarily a black and white relationship. That relationship also falls back. That relationship can turn into whatever the client perceives the relationship to be, and that can be very hard to argue, right? So notes, documentation is absolutely key.
Right.
Yes.
And that's going to be this case here.
Yes.
So, I'll get to the end result of all this in a second. But the interesting point about this case is that he turned $88,000 into $415 million, and then when Tesla went in the other direction, the impact of leverage and margin and options being binary and going to zero, he lost all $415 million. It went to zero. And this was a sad tale. Now, look, here, I'm going to bring up one more chart for you. Can you bring up the next chart for me, Brent? Actually, maybe I can. Don't flip it? Okay, you've got it? Yeah, no. This one. Hold on. This one right here. One thing about markets you have to understand is you have to understand some basics of statistics. There's what's called the mean, the median, and the mode. Mean is the average, right? What's the average return of stocks over time, or a stock over time? So just say NVIDIA, right? What's the average return of NVIDIA over time? That's the mean. What's the median? The median strips out the highs and the lows and looks at the price return X out those kind of tail events that occur with the price. Maybe there was a really sharp spike in the price or a really big drop like back in 2020 where it was down 90%, 70%, whatever it was, 2022. So you strip some of those things out to get the median. And then there's the mode. The interesting thing is there was a study done by Hendrik Bessembinder, there's a word for you, who examined the history of 29,000 stocks in the United States over 90 years of the good data that was available. He also examined 64,000 stocks outside of the U.S. on a slightly shorter term horizon because of what the available data was. And the mode shows the most repeated value of stocks over time. And that is the interesting point about this. Out of all the stocks that he looked at, 70% underperformed the index. The mode of the stocks he examined was a loss of 100%. When we come back, we're going to talk a little bit about managing risk and the outcome of this particular, well, it's not, the case is still in process right now between Christopher and RBC. Has not gone to court yet, but we'll talk about the outcome of this and what he should have thought about doing along the way. And John Penn, I'll discuss that with you. Don't go away. Be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Slept right through my alarm this morning. My wife woke me up. I was in the middle of this dream when she woke me up of the alien armada coming to Earth.
The Real Investment Show podcast.
My wife's ex-husband's new wife is a flat earther. She believes the Earth is flat. And so in my dream, the alien armada is coming to explain to her that the Earth is actually round.
Same show, your schedule.
Nice.
Anyway, I woke up late, so here I am.
I bet you Richard could do a script treatment of that one.
At realinvestmentadvice.com.
I'm thinking more like Mars Attacks. That was the one.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So just wanted to wrap up this conversation with John, just talk a little bit through this analysis on this case. So this case was this young man invested $88,000, ran it up to $415 million in a couple of years, trading options, going heavily on margin, etc. And then basically when the market reversed, leverage and optionality, all that kicks in, and he wound up losing everything, right, including his $88,000. He's now suing RBC, saying, well, they didn't advise him differently. I assure you, and maybe I'm wrong, maybe in this case, RBC never advised him to do anything, right? It was just all about how to make more money and how to do, how to avoid, minimize his taxes, those type of things. I am sure that anybody And if RBC never advised him to do anything, then shame on them, right?
I agree.
Yeah.
I find it hard to believe that they didn't even at least mention, hey, you know what? It's time to take some chips off the table here, bud. Just a little bit.
You start out with $88,000. You don't have, your income is maybe $100,000 a year, and you've got 400. And look, and just simply from the function of RBC, right? When you have that much money stretched out on margin, it would seem like also just kind of a case of protecting their own books that they would have made some recommendations about, maybe taking some gains. But, again, the client's going to do what he wants to do. He doesn't have to take the advice of the broker. But in the event, in the end, when things go bad, the first person they blame is the advisor. And that's what I was saying. That's what we were talking about earlier, is that John always takes extremely good notes. All of our advisors take extremely good notes of meetings, because in the situation where something goes horribly wrong, then it's important to have those notes, right? That, hey, we had this conversation on this date saying we recommended this and you didn't want to do it. So, but there's some things you should have done. First of all, obviously when you reach the first 10 million, right? $10 million is life-changing money for a lot of people.
I mean, you've made it, right?
Yeah.
For a lot of, that's...
depending on your lifestyle,
yeah,
right? And
true.
if you want private jets and yachts, no 10 million are going to do it.
That's right.
But at 10 million, you take $1 million and you shove it into U.S. Treasuries, right? You just buy Treasuries, set them over there, who cares, right? And you're trading on 9 million, but you got $1 million in the bank now, right? At 20 million, you take another $1 million off, throw that in the bank, trade with the other 20, right? If he would have just done some method of just taking some profits and shoving some money into treasuries, the two things would have happened. First of all, when the margin calls came, he wouldn't have been wiped out. And secondly, he probably would have left the table with $100 million, which isn't bad.
I mean, that's family legacy forever, right? I mean, that's big time. Mm-hmm.
Another option he could have done, John, which also would have helped him, is just run a trailing stop loss in all this.
True.
Right? So you run trailing stop losses on your shares of Tesla, and make sure that you have some stop losses set up on your options. And then also, if you're buying options, third option here is just to hedge your position by buying some puts, right? Just in case the price reverses. If I'm long calls, which are, again, we go back to talking about options. If you don't understand options, it's okay. Basically, options are just a contract, and they have a value and a price. And on a certain date, which is always the third Friday of the month, on a certain date, that contract matures. And you either make money or you lose 100% of your money. And there's no in between. So if I'm long calls that can expire at zero because the price went down, why wouldn't I offset that with a put that would go up in value to offset the risk of my calls? Now, having said that, those options, taking some profits, diversifying your portfolio a little bit into something else, right? Set some trailing stops. He wouldn't have been able to get to 415 million. His 88,000 would have probably likely capped out at, a couple $100 million, maybe 150 million. Anybody complaining here? But when everything reversed against him, he probably still would have walked away at the end of the day with, $75, $100 million in value. So there's so many things that he could have done just to offset some of that risk. And by the way, this goes to the article that we posted out last week on our website. So to learn more about risk management, and a lot of these philosophies are about how we manage risk in our portfolios at RIA Advisors, we have an article talking about Howard Marks and risk, the importance of understanding what risk really is. Risk isn't what most people think it is. Risk is a very different animal. And so that article on the website from last Tuesday, it's also on Substack, so either place, but read that article. If you're investing capital, read that article about risk. It's very important. There's a link to it in today's article on this article called Greed and How to Lose 100% of Your Money. But the important thing here, John, is that as investors, there's two things that we need to understand. The first is, as I said before, in order to make money, you've got to be a bit greedy, you've got to be optimistic, and you've got to be willing to take risk. If you can't do those things, you're not going to make money in the markets. But you have to have a controlled level of greed. Even in the movie Wall Street, right? Michael Douglas's greed got him thrown into jail. And of course, you have to watch the second Wall Street movie, Money Never Sleeps, to see how he got out of jail and what happened after that. But greed has a very dark side to it, which is ultimately it will lead to very destructive events if you let greed become uncontrolled.
Yeah, and I think it's important. You got to find a way to separate your emotion from this too, because I know greed is it's investing is emotional, period. Mm-hmm. But I can't tell you. I mean, still, how many times we visit with individuals and families, and they seem to kind of put all of their money into, okay, well, this is doing well, this is doing well, this is doing well, this is all I know. I'm comfortable with this particular stock position. It keeps going up, it keeps going up, it keeps going up. So I'm going to keep putting my money into it. Right. In this case, with this gentleman, Tesla, it moved against him, right? Yep. But how many times do you put all of your eggs into one basket? And that basket, what if there's a bad earnings report, or what if that basket goes away? I mean, this is having memories of my mind, completely different situation on why this stock went to zero. But remember the days of Enron, right? I mean, but I was back at Schwab at those days, and it just didn't matter. No matter what folks were putting their money into, it was Enron. And I remember like it was yesterday, where a gentleman came into my office. I'd never met him before, and Schwab at the time, they were kind of pioneering online trading. So folks you kind of just go online, and it was their sandbox, and they could do whatever they wanted. But the gentleman came in, and I'd never met him before. He sat down at my desk, and he just had his hands over his face and just sobbing like a baby. And I said, "What's going on?" And he said, "I've lost everything." Mm-hmm. He lost every dollar he ever invested, and he put it all in Enron. Fortunately, he was in his mid-50s, and he still had a lot of runway, and he was still in his prime earning years, so he could make up what he lost, or a good chunk of it. What he was really upset about and crying about was that he had lost every dollar of his mom's money. Yep. Gone. Yep. And now he's going to have to support her for the rest of her and his life. Yep. Right? And it's just you would think that, hey, everything was great until it wasn't, and it just like that overnight, gone. Right.
But see, Enron was 1999, 2000. Yes. We saw the same thing happen in 2007, 2008, mm-hmm. right? We saw Citigroup go from $180 a share to $3, right? I mean, I had clients during that period that it's like, oh no, this was grandpa's, Citigroup stock that he bought back in 1974 or whatever it was. And I'm not going to sell that. That was his stock. And I go, but if this thing goes down, you're going to lose all that. That's I'm not going to sell it. And they wound up losing a ton of money. There's three things, though. This is the thing about greed. There's three destructive forms of greed that John and I and Danny and Richard, we all deal with this with clients. It's the need to make more, the lack of knowing when enough is enough, right? Which in this case is at 100 million or 200 million. At what point did Christopher not go, that's $100 million. I'm done.
Yeah, I don't have to, if he was a carpenter, I don't have to go lay carpet or build frames. I don't have to do any of this ever again if I don't want to.
Right.
Period.
And at what point do you just say, that's enough, I'm out? I don't care. There's an old story about, leaving some meat on the bone for somebody else, right? And that's part of the story here is at what point did Christopher not go, man, it's $100 million or $200 million or $300 million? And see, and instead of thinking about, enough is enough, it's like, how do I make more? Mm-hmm. I'm going to get to $1 billion. I'm going to be a billionaire out of this. But at $100 million, after you pay taxes, right, you're still golden. And then, of course, the last is one of the other traps that got him, and we see this a lot with clients, John, is the unwillingness to pay taxes.
That's it. I still just, I don't want to pay tax. I don't want to pay the tax. So I'm up X percent. Well, would you rather pay a long-term capital gain and put some money in your pocket, or even if it's a short-term capital gain, and you're just taking a little bit of risk off the table, kind of taking some fruit off the tree along the way as that tree is producing fruit for you? I mean, after tax, wouldn't you rather put a little bit of money in your pocket so that way if things get a little hairy out there, you're already in a better position,
Yep.
right?
Hey, good news for Christopher, though. No taxes.
That's right. Yeah, he doesn't have any taxes to pay.
And he's going to have losses to write off for
Ever.
415 million years.
My goodness.
When we come back, we're going to wrap up the show. I want to come back and just finish up with what the advisor should have done in this case, and also talk a little bit about this is why you hire active managers to help you manage your portfolio better. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, a correction, I was corrected in chat this morning. I said that he'd have have these tax write-offs for 400 million years because of 450 million. The correction is that he actually only lost $88,000 because he never took the gains.
That's right. He never sold it.
So he has $88,000 worth of losses to take. There may be some other gains in there somewhere that he's gonna have to deal with at some point. Anyway. So a couple of just kind of concluding points. There's some things that the advisor should have done, and this is something that we take very seriously in our firm because, again, we act as fiduciaries and advisors for our clients, and not just from the standpoint, as I've told you before, my job is the least important in the whole firm, which is just managing the portfolios. What John and Richard and Danny do are the ones that make sure that your financial life is secure, which is much more important. They're doing the financial planning, the Social Security, the Medicare, the taxation planning, all that type of stuff, insurance planning that makes sure that, great, you've got money, but, is it protected and is your family protected and all those things? That's a real important value of what goes on. And again, what my job is just to make sure the money's growing. Right, that's my whole function.
Just as and equally as important, by the way.
Well,
yes, it is.
That,
it's a collaborative approach.
So there you go. All right. So anyway, what should the advisor have done? First of all, is obviously, proactively encourage diversification. Right? Hey, take some money off the table, put it into something else. do something a little different, to help shield some risk. Insisted on setting up risk management tools. As we talked about, if you're going to buy calls, great, buy some puts. It's just a little bit of money, buy some puts, right? You're already strung out there on the leverage. So, a little bit more on puts certainly won't hurt you at all. Obviously, maintain really clear communication. And again, as John and I mentioned earlier, that, if they're not listening to verbal advice, send written advice. Send emails, send letters saying, hey, we're recommending that you do this. Because again, in a lot of cases, I feel pretty confident that if I went and talked to RBC, they're saying, oh yeah, we told the guy, right? We don't know their side of the story yet. We only know Christopher's side of the story. Good news is that this was all screenshotted on Reddit, and he did get 6,900 views on his post. So with thumbs ups on what happened. But there's a fourth step that, as an advisor, RBC should have taken. And this is something that we've done in the past and we will continue to do in the future, is that if we have a multi-tier process before accepting a prospect as a client at our firm. We want to make sure that there's, when you're in, people say, I'm going to go interview an advisor. That's great. Well, when you interview the advisor, trust me, the advisor is interviewing you, or should be. And they should be interviewing you to make sure that you're a good fit for the culture and the philosophy of the firm, and be willing not to accept that client because of that. And more than a few times in the past, we've taken on somebody who we thought was going to be a really good fit for the firm, and turned out that they weren't really aligned with our views, and we fired them. And we have that capability, just like you have the ability to quit your advisor and move somebody else. Your advisor has the ability to fire you.
That's right.
And then this is probably, John, at some point in there, RBC, and they didn't obviously, but at some point in there when the risk and speculation was getting really extended. I know they were making money off this deal.
Yeah, I'm sure that margin interest was looking pretty sweet.
I'm sure it was on $400 million.
Yeah.
But at some point, RBC should have said, if this turns out badly, we're going to get sued. Mm-hmm. And that's the first thing. I mean, there's a lawyer just waiting to jump on these types of cases. And we're going to get sued, and we need to terminate this relationship.
Yeah. Yeah, and that's not really a fun conversation to have with somebody, but just to your point, when it comes to engaging with an advisor and engaging with a fiduciary, just as folks out there are looking for a relationship with an advisor on a long-term standpoint, we as advisors, we as fiduciaries, we want long-term relationships with you too, and your family. And I can't tell you how fortunate I feel that I started working with moms and dads, and now I'm working with sons and daughters, and I'm working with grandchildren, kind of multi-family relationships. It's incredible. It's truly a blessing to be able to serve the individuals and families that we work with. But there's an underlying theme. We have our philosophies match what they're looking for and what we do. There is in our approach and how we, how Lance and the team, how they manage risk and how they, approach investment management and how we approach planning. There's a match there. There's a fit from a philosophy standpoint, and that is so crucial because, to Lance's point earlier, as when we are having those initial conversations, and both parties are deciding if we're going to engage with each other in this relationship, as much as you are interviewing us, or let's say you're out there visiting with multiple advisors, and you should visit when you are looking to make that decision of engaging with a financial advisor, with a fiduciary, you should visit with a couple different firms because you want to find out the one that has the right fit for you. But just as you are interviewing us, guess what? If I'm visiting with you, I'm going to be interviewing you too, because in the back of my mind, I'm already thinking down the road, are you going to be a good fit here? Is this really going to work out? And if in the times where I deliver the message, Lance, where I say, you know what, Mr. or Mrs. So-and-so, I don't think we're going to be a good fit for what you're looking for. You probably want to go out there and visit with a different firm. That is not a reverse psychology approach to try to bring you on as a client. If I'm telling you,
although it works.
If I'm telling you that I don't think we're going to be a good fit for each other, I mean it.
Yeah, but it is funny you say that, because more than once when you tell
wait. Yeah, no, it's not what I'm trying to do here. Trust me. Yeah.
Yeah. And again, it's really in your best interest, because, there's a lot of times that clients come over and they go, well, or prospects come over and they want to become a client. And they're like, oh, I'm just looking for 12% returns. We can't deliver that. And so we're not going to engage you as a client with you expecting us to generate 12% annualized returns when we just simply can't do that.
Yeah. And looking back at the market, what the market's done over the last several decades, it's all in the past. Who knows what the future holds as far as what the market's going to do, right? Now, the market could give us historical returns moving forward. We don't know. But if your financial plan, if we look at your financial plan and you have to have 10% or 12% a year every year for this to work, one bad year and your plan's going to be derailed. You just can't. I mean, nobody knows what the future holds, but to try to expect your money to compound at 12% every year on an ongoing basis, that's just not realistic. Yeah. It's just not.
Right. No, I agree. But this brings us just real quick. We've got about 3 minutes left here, but this is why hiring an active manager. So you really have two choices to hire an advisor. Either you can hire an advisor to do passive indexing, and you're going to basically track the index. The problem with that is that when we do eventually get into the next secular bear market, indexing is not going to work well. And this is why you want to hire an active manager. Yes, hiring an active manager is going to underperform in some up years, but the goal for an active manager is to really outperform in down years and protect that capital, right? Keep you from losing 100% of your money, right? That's why you hire an active manager to do that. And we've talked about before about the SPIVA reports talk about, 88% of fund managers underperformed last year. That's last year. And yes, there's always a manager that's going to underperform in an up year. There's always a manager who's going to underperform in a down year. Mm-hmm. But what that SPIVA report doesn't look at is how did a manager do over 25 years, right? Did he regularly underperform? It's not a breakdown of it. It's just cumulative for 1 year of who outperformed and who didn't. A manager, Bill Miller, one of the greatest legacies of the Legg Mason Value Fund, outperformed the index for 15 years. The ability to do that is like 1.8 bajillion odds to one, right? I mean, just to be able to do it for 15 years is actually impossible. The fact that he did is amazing. But he then fell apart in 2008, right?
Yeah.
It happens. But it doesn't, but you look back at Peter Lynch and these guys, yes, they all underperformed in 1 year or the other, but over the long term, Warren Buffett, they've killed the index by being active managers.
Yeah, it's, I think a lot of the individuals and families that we serve, they want their dollars to participate and work in the market. So that way, they can continue to do the things that they want to do and live their lives and afford the things that they want to do, keep their purchasing power, fight inflation, fight taxes, do all these things. But at the same time, too, if markets really get wiry out there, they want to work with a firm that can help, position portfolios to act more conservatively during times like that, lose less than what the market's losing. So that way, hey, if the bottom falls out of this thing, they just don't want to get derailed. They want to be able to continue to pick up and to, continue their life like they were before. And so I get that question a lot around, well, why would I decide to, John, why should I hire an active manager to help me with my portfolio? It really comes down to managing risk. Mm-hmm. In addition to that portfolio management aspect of things, all those planning areas, all those other areas of your financial life that will help you with, really the active part too is our job is to save you from yourself a little bit too.
Greed is good.
So are ribs for Thanksgiving.
Brisket, chicken.
Mm-hmm.
There you go. All right, wraps up the show for today. Be sure and hit that like button before you leave the chat this morning. We need the ratio. It's not just the number of likes, it's the ratio of likes to viewers that's very important. So we need if there's 600 of you in the window, we need like 500 of you to hit the like button. So hit that like button. Appreciate it very much. Get by the website, that article on greed and risk, both on the website now, realinvestmentadvice.com. It's also on our Substack channel we've started. So if you are over on Substack, be sure and follow us there. You'll get updates by email every morning when we post stuff, daily market commentaries, etc. Just kind of convenient, all in one place. Realinvestmentadvice.com. Have a great day. See you back here tomorrow with Danny Ratliff.